From Barangaroo Studios, this is the COB, brought to you by eToro. Invest in ASX shares with $0 commission.
Well, hello there, it's Friday, it's the COB, and this is all the stuff you need to know about the day in business and markets. I'm Kyle Rodder.
And I am Tessa Arcilia. Again, the second day with you guys, and it's Friday, Kyle.
It
of
is.
A very exciting, wink, wink, week. We were trying to make it exciting.
Yeah.
But yeah, we did see movement. Yesterday we were talking about no movement, but we did see movement today. Downwards though, unfortunately, right? So let's look at the ASX at the moment, and well, SIBO, we are at 1,403. Do you have it on your screen?
I do.
Down
0.42% for the session.
Yeah, 30 points down. There you go.
30 points down, and again, as you can see on your screen there, 0.57% lower for the SIBO 200. And we have been sort of talking very much about the market picking a direction for the week, which it seemed to refuse to do for the most part. It picked one today. It wasn't emphatic, but it was down.
No.
So effectively, the day's loss today is the week's loss, and we end off on a negative note. But
yeah,
I mean,
just wanted to look at some of the sectors, because we have the biggest losers, materials today, and financials. I think financials, maybe the banks are tracking the broader negative sentiment that we've been gathering from all the data coming out, the CPIs and the US jobless claims, but then there's also the news today locally. The Australian regulator wants to look into how banks have been translating that hike in interest rates to bank deposits.
Interesting.
And we saw that, there were commentators saying that they saw movement after that announcement came out. So that could be some reason why financials could be down. Miners, of course, iron ore prices were down.
Yeah,
so
I think
that's
4% today. Interesting.
Yeah, something that we're looking at today. What caught your attention?
Well, actually, it was the fact that it was a bit of a blue chip slip. So if you look at the ASX 300, down by about 0.5%, 0.4%, we haven't got obviously the final trades going through the market yet with the post-market auction. But the ASX 20, so the 20 biggest stocks in the market, actually down 0.82%. So again, some of these bigger names, mostly because it is a banks and material story, are leading the market lower. But it's, again, those largest cap stocks that seem to be selling off. Does that signal anything? I mean, you could probably try and construct some kind of narrative around it. But people are backing out of some of those higher quality names. So very interesting.
But we also had some production reports today. So I think that might have impacted very specific stocks. Like you had BHP, a downgrade, a full year in their Escondida copper and nickel production expectations. Interestingly enough, that's in Chile. So and some news again from Chile today, the president said he wants to nationalize the lithium sector. That would probably, it could impact Australian companies that have exposure to that space over there. And you had Whitehaven Coal, it was up today because of an approved investment in mines. So I think it was stock dependent, some of the news that came out today, especially with those production reports. Yeah,
no, it's without a doubt. And we were flagging yesterday that those production reports would be significant. And on balance, they seem to have largely disappointed investors throughout the week, some of those production reports. But this is our three themes for the day. Blue chips, we've just spoken about that. Down for the week, we've just spoken about that. One thing I wanted to bring up though was battling on, not so much the equity market, but the Australian economy, because I had a lot of macro conversations today. And one thing that stood out, didn't move the markets, but PMI figures out of Judo Bank moved back into expansionary territory. And a lot of the chat today was talking about the resilience in the Australian economy.
And how would that translate to rates again? Here we go. When you see that resilience in the economy, that's the next question, isn't it? What did you get from some of the guests that you spoke to today?
Higher for longer, and it all seems to be some variety of that kind of story. From ANZ, Adelaide Timbrell was on today giving the house view from the bank there about where rates will go. Thinks one more 25 basis point hike is on the cards. Not until August, but still another 25 to go. Warren Hogan has crisscrossed the public sector, the tertiary education sector, all these different areas of the economics world. He reckons we need to have a 4 in front of the cash rate before it really starts to slow the economy. And of course, he's from Judo Bank too, which releases that PMI data. So had a very good sort of knowledge and insight on what that data could potentially mean. But I mean, it's a good news and bad news thing. If you're a part of the house, if you're a household, you're a business, that might be a good thing. But again, the RBA doesn't want good times to last right now.
It's really interesting to see how Australia is going to fare compared to the rest of the world, because earlier when we were listening to what was happening in the United States, you had 10-year bond yields kind of going down, and the assumption there is maybe investors are looking at the slowdown, rather than interest rate hike fears, they're looking at the general broad slowdown.
Yeah, definitely. I've tried to use this joke a couple of times. It just seems to offend people, but instead of like going down like a Led Zeppelin, like we say, going down like a SpaceX rocket. But yeah, topical. Too soon.
Very topical today. You saw that video?
Yeah, we saw that video. We've run that a few times. You've got to obviously commend the bold and brave efforts of Elon Musk, of course, trying to send people to space today. It wasn't perhaps a small step for man, perhaps, but not a large step for mankind in this instance. But let's get across some of those areas of the market that we were just alluding to, starting off with the metals and mining. We'll just get across these very quickly because while it's on your screen there, painted in red, down for the day, the miners.
Yeah, absolutely, and I think it's also because of the pressures coming from the commodity space there. A lot of China news, trying to read what the China impact is, and looking at the prices. You have inventories, again, iron ore inventories are just are going up, so prices are going down, so that's going to affect some of the miners.
Yes, and there we can see another, I suppose, iteration of that chart. So again, really just hammers home that miners were a part of the story today. But Tessa, the stock of the day, we actually had two of our favourite small cap commentators, small cap analysts on to talk about a company called Fiducian. Now, I wasn't across this company before.
Yeah, tell me about that.
Often the best thing about when Luke Winchester and Claude Walker come on is that they bring a new name to the table. And Fiducian Group is a diversified financial group offering funds management, financial planning, and platform administration, many, many more. A little bit of a fintech, I suppose. Let's hear what the guys had to say about this stock. It was a small cap special.
Just hold throughout the cycle, and I believe you will do well. There's some succession risk as the founder maybe grows older. He's been there for a very long time, but having said that, I kind of, having watched this in public for 10 years now, my entire career I've been following this stock. I've seen them do a really solid job growing a business, growing earnings per share. That they are up a lot. They have paid dividends, and it is really a share price does follow earnings per share story. It's stomach churning when seeing this thing trade. There's not many buyers, not many sellers. Today we've got $20,000 traded, and that's when a quarterly's out. So that gives you an idea of how it could go up and down. But I do admire, I admire the company, and over the long term, it has been a good one to trade because the long-term trajectory has been up.
I think you can buy it today, as Claude says. That's sort of 14, 15 times earnings where it's at. That's a fair multiple for this business and the long-term growth. You may be able to get it cheaper. There's been times where Fiducian's probably traded on 10, 11 times earnings. But as it gets bigger and liquidity comes in, go back to what Claude said at the start of the show, that's where more funds can start to look at this business as it creeps up towards a 300, 400, 500 mil market cap. Liquidity naturally comes in and multiples naturally shift up. So it's probably at least a hold for me, Andrew, but a buy for the right investor who can stomach small cap volatility with a long-term focus.
For those who are interested in the small cap space, I guess this is one to watch, isn't it, Kyle?
Yeah, and for those two guys, kind of like a holdy buy or a buy hold. They like the stock. Not necessarily an emphatic answer to a buy hold style, but nevertheless, I think it's a pretty good company.
Yeah, it is. I just wanted to touch on our third theme of today. We said down for the week. Remember yesterday we were talking about the semiconductor sector. We saw that result from TSMC. They're predicting a Q2 sale to drop by 16%. And this is a very geopolitically sensitive industry. And we know that US President Joe Biden potentially would be imposing some restrictions on American investment into key Chinese industries. And I think that's going to impact quite a lot of companies. Even, TSMC said they're in talks with the government just to protect this. And, semiconductor business is huge. And we were watching that yesterday.
Yeah, absolutely. Tell us as well, because the audience now are getting well familiar with you over the last 2 days. But you've worked in that kind of hot area of the world when it comes to China, spending some time in Hong Kong. the narrative can change depending on where you are in the world, the reportage can change. From where you've experienced things, the way China could be interpreting these sorts of moves by the United States, would this be treated as an act of hostility? Could this be prompt a greater retaliation, or at least, more brinkmanship, some of that wolf warrior diplomacy perhaps? I mean, how does this news normally get digested by the Chinese government and I guess the Chinese broader Asian public in that part of the world?
Yeah, I think if we could read the mind of the Chinese government, that person would be a very rich person, but it is difficult. But we can take the cues from the Chinese government. They will see it as an act of hostility, and they, we've seen trade wars happening, and this is what diplomats and politicians are trying to avoid, because the impacts are very deep. And so if this does happen, you can bet your bottom dollar China will have something to go against that, tit for tat, and you don't really want to go down that path given the economic climate that we're already in. Broader Chinese reaction, I think, there is a sense of support. There's a sense of, well, if you're attacking, I say attacking might be a strong word, but if you're putting us in this position, then we will have to, like playing chess, we will have to make our move to equivalent to that.
And as we know, the Asian region is sort of an increasingly incendiary sort of environment.
Absolutely.
So it's a real hot spot, and it goes again back to this sort of TSMC story and these other investment
just keep an eye on the
applications.
G7. I think G7 summit May in Japan. I think we'll probably hear a lot of in the geopolitical space that could actually move markets. You might hear some things from there. Yeah,
really interesting. Well, we did talk about how the market was lower for the week, and as we always do at this time of the week, we welcome Dr. Shane Oliver from AMP Capital to talk through all the things that did occur. Dr. Oliver, thanks for joining us today. Might just start at a very surface level question, because we've been talking all week about how there's been this sort of apparent lull in equities locally and across the world. I mean, you look at the VIX in the United States down to 52-week lows. How have you seen what's happened on the markets? It does seem to be almost a level of complacency in the market even.
Yeah, well, markets, I guess, to some degree have been boosted by signs that inflation's peaking, and therefore there's an optimism that central banks will soon finish the job and will be able to, by later this year, start cutting interest rates. I mean, you can see in our inflation indicator there for the US, ongoing downwards pressure coming through as the supply side problems have relieved themselves and freight costs have come down. Most business surveys point to lower inflation. Even in Australia, out of the PMIs today, the ongoing downwards pressure in the inflation components remains there, even though the economic activity components are sort of bouncing around a little bit. So I think that's what's buoying markets. And at the same time, we're not seeing a collapse in economic activity. You mentioned earlier the PMI in Australia. Likewise, internationally, we haven't yet seen a collapse, even though there are increasing warning signs in relation to the US. The leading indicator overnight, the Philadelphia Fed, jobless claims on the rise, but generally speaking, growth has held up better than expected. And so I think that sort of Goldilocks scenario that we've come into, at least for now anyway, is what's supporting markets. Whether it can remain the case or not, I know there's the old saying, sell in May, go away. We've had a good start to the year. It's quite conceivable we come into a rougher patch. We've got the debt ceiling issue ahead of us in the US, risks of weaker economic growth, and it's probably still a while before central banks start cutting interest rates, even if we are close to the top. So we could easily have a bit of a leg down through that May-September quarter period, and then rally into year end. So I wouldn't necessarily get too complacent given the relative strength we've seen in markets so far this year to date.
Yeah, but even if, Shane, you say you're not complacent, but you're trying to find direction, I think the problem, especially with this week, is that investors are having a hard time deciding which indicator to take on board and which direction to go. So where do you find direction? That sounds really philosophical, but yeah, where would you go? Tell investors to go.
I read these books. I don't know. The answer is within. Who knows? There's no clear answer to that. So obviously, we are going through a difficult period. I noticed straight behind me somewhere there on this side is Eric Idle's book, Always Look on the Bright Side of Life. So I try to look on the bright side of life. But, it's difficult. There's so many conflicting indicators at present that it does confuse things quite dramatically. But I think in a longer term sense, we are coming into an environment where inflation will come down. which ultimately will be supportive of markets. It's just that right here, right now, I'm still feeling a bit cautious about things because I am conscious we've seen good rallies in markets and we could go through a rougher patch. So I'd be sort of a little bit cautious at present. And you know, it's not clear that these issues are fully resolved around the recession risk that we're seeing internationally, and obviously to a lesser degree in Australia, even though so far the data has been somewhat better than might have been feared.
I do have Monty Python in my head now, and funnily enough, not the Life of Brian song, but the Galaxy song, which I always find solace in from The Meaning of Life. But anyway, I digress. Might chuck that one on later on. Let's, if we may, talk about just the RBA this week. And well, we'll go to the minutes in a second, but I mean, I've been fascinated, obviously, like anyone, with the review and the results of the review that has come out from the government about the RBA from here, that the changes that could be made in terms of its structure and the way that it does business effectively. Widely, it seems to have been approved by most economists. I mean, do you think, in your opinion, do you give perhaps the 51 recommendations your tick of approval?
The more I think about it, the more I don't. I mean, the basic model being proposed is a shift to what you sort of see, I guess, in the UK, Canada, the US and New Zealand. That is where you have less meetings, you have you have a monetary policy committee there with a bunch of economists on it. That's probably a good thing. You have press conferences after each meeting. You have more speakers out there talking about monetary policy. And the more I think about it, I'm not entirely convinced that those countries have seen better economic outcomes than the Reserve Bank has actually delivered in Australia. So while you can make criticism of the RBA, and yes, I think there should be more economists on the board and so on, and many of those recommendations make sense, it is quite a big change, and I do worry that we're messing with something which has actually been working quite well. Yes, some mistakes were made around the pandemic, but other central banks made mistakes as well. It was a very uncertain period. It's always easy to look back in hindsight. But I'm not entirely convinced that shifting to the model that's proposed will lead to any outcome which is different or better than what we currently have, and therefore I'm sort of questioning now whether it's actually worth it. That's my 2 cents on it. I mean, I think a lot of people would have come into this review hoping that maybe it will mean less pressure on interest rates. But if you look at all those other central banks that have less frequent meetings, press conferences after each meeting, and so on, they've actually raised interest rates more than the Reserve Bank, and they've done it in a less balanced way than the Reserve Bank has. So I'm not entirely convinced that what's being proposed is necessarily the right thing. So at the end of the week, I've sort of become a little bit sceptical about the review, to be honest with you, and maybe I'm parting company with other economists out there who are giving those recommendations a tick of approval. But the more I think about it, the Reserve Bank has delivered pretty well for Australia over the last 30 years, and even the review acknowledges that. And therefore, I don't see a strong case to make these sort of radical changes, which could upset the apple cart and lead to a worse outcome.
All right. Well, I guess, this, I don't like the saying, but it is what it is. We'll wait and see. We'll see if this new structure, this new plan will actually bring in some sort of change, if you will. Shane, I'd like to ask about this report that we saw in the States, because it's really interesting. The biggest money market outflow since 2020. Now, you've got about $69 billion that leaked out of U.S. money market funds week ending April 19. Where is this money movement going? Do you think that this is the sign of that recession where you've got institutional investors going, oh, hang on a second, let's pull it out, sit tight and wait? Is this an indicator that we can actually take on board and make a concrete move on?
Look, it's hard to know where that money went. I mean, if you're talking about money market funds, then presumably it wasn't taken out of the equity market. It may be that money is to pay tax returns and so on in the US. I mean, I know some people who look at liquidity as a driver of markets. It's been quite positive at the start of the year, but that's set to turn less positive. I think we're seeing some of the weakest tax returns in a long time in the US, the tail end of this financial year in the US. So that means less money available. So maybe that's another factor there. But bottom line is, it's hard to know where that money went. But you could argue that it's probably not gone into the share market, but it potentially does mean that there's less money around to come into shares going forward. And I suspect that it could have been sucked out of the economic system, which could actually be a bit of a negative for markets over the period ahead.
That's a good point that you bring, though, that tax season is, I think it's on Tuesday. They have to make their submission, so that probably also impacted it. Anyway, do you have any...
Yeah, no, of course. I just wanted to stay in the US because actually one thing that was brought to the table a couple of times, and it's starting to be, I think, acknowledged a little bit more, at least amongst the commentariat, as it's risk to the markets. It's just the debt ceiling situation. I mean, for you, is this something that you've been keeping a close watch on? Because I mean, if you look at credit default swap spreads, they've blown out. And again, this has only been brought to my attention over the last couple of days. But for you, are you fairly, I suppose, cognizant of the risks here?
I am, and I mean, it's always hard, this one, because the debt ceiling was actually reached back in January. A bit of excitement at the time, but that was premature because we know they have these cash balances which they can draw down. The general feeling was that would take us out at the middle of the year. There is a risk that with less revenue coming into the US tax office, that it may come earlier, say sometime in June. And in the meantime, the US House looks like it's trying to pass a bill. Remains to be seen whether they can do that. If they can't do it, then that would be a bit of a problem because it means that the Republican majority in the House can't agree amongst themselves on what to do. And that could mean a long, drawn-out process here. This is going to be a source of uncertainty. I mean, it'd be nice to think that it could be resolved easily. The last time we had something that was significant on this front was 2013, also back in 2011. We know in 2011 it didn't end so well with a debt downgrade in the US. So it is something that investors should be cautious about. So you'd sort of add it to sell in May, go away, the liquidity situation getting a bit more tenuous. We're coming up to the period where the debt ceiling will become more of an issue. We're not there yet. I think at the earliest it's probably going to be mid-June before it becomes an issue, but we're going to start hearing more about it, particularly if the House can't pass a bill on this, worries about recession. So, I mean, it's just another factor that could give us a bit of a rough patch through that late May, middle of the year period into the September quarter.
It's going to be a fascinating couple of months, and that's just in the US, let alone what we can expect from here. Dr. Oliver, we'll wrap it up. It's, as always, really appreciate your insights. We'll talk to you next week.
Yeah, thank you very much.
That'd be good. Thanks, Carl. Thanks, Tessa. Take care.
Dr. Shane Oliver from AMP Capital there. Okay, well, let's shift on because we want to have a little bit of a look at what's on overnight now. And global PMI surveys, we already alluded to the Aussie Judo Bank one that surprisingly moved back into expansionary territory. Procter & Gamble is probably the big one out of the US in terms of earnings. Not so big, but nevertheless, we're still watching very closely that earnings story in the States. Yeah, indeed. And we didn't, it was quite disappointing the last few days. We'll see if we have any big companies that will post something different. Yeah, no, without a doubt. And we've got those big tech names coming up in the next few weeks as well. So you start to get 25% of the total market cap of the S&P 500 reporting, and it always seems to fall around a Fed meeting as well. So we're looking for catalysts Thursday, Friday, maybe not next week, but the week after. We're going to be and let's not forget that CPI. I mean, I'm really looking forward to seeing the local CPI, and that probably can tell us a bit more on where we're headed. It'd be surprising. I don't know. What do you expect? It'd be surprising if it remained resilient? Well, I mean, I think the sense now is that it'll come down or that it'll repeat. But, if we looked at the UK situation this week, it's about that stickiness. It's just not coming down as quickly as many, economists and investors would like. So that's the concern. That's a concern from the start, that once inflation gets embedded within, consumer psychology, it's really hard to shake out. You need a pretty good shrink to try and get you over that one. So, really, it's going to be about how quickly it comes down, and then we'll be turning to that May RBA meeting. Oh, indeed. Okay, leaders and laggards now. We've covered a few of
Kind
them
of, yeah,
already,
we
but
pretty
let's
much
get the
have.
let's get the
So
leaders up now. And well, we spoke about Whitehaven Coal before.
Yeah, that was, I think so, the leader there approved an investment in mining equipment for work to start its Vickery coal deposit. I think we saw that news come out early in the day, so that's no surprise there. And still in the resources space, Lynas also up on a record production from its Malaysia operations.
Yeah, Boral as well, up by 5.4%. And I'm just trying to find some news on that today. It doesn't jump out to me necessarily. So, I mean, a fairly significant move there for a fairly large stock. Pilbara Minerals back above
It was there
$4.
the last few weeks, huh?
Yeah, it's
the
been
days.
Pilbara.
Pilbara, yeah.
Yeah, no, Pilbara has, yeah, absolutely, up 2.5%. And you do sort of wonder how that news that you were talking about before as far as Chile, so significant when it comes to a lot of these rare earths and major metals, lithium in particular, whether it will be on balance maybe a benefit to our miners.
The announcement that the president there was careful to say that all existing contracts will not be touched, but in future this is what we'd like to do.
Yeah.
So but still that is going to work its way into the companies. All right, laggards. Bank of Queensland still there.
Yeah, it's been a choppy week for them, and had the benefit, the great privilege of talking to the CEO and Managing Director Patrick Allaway yesterday after the company's results were announced. Now, they did a lot of the airing the dirty laundry at the start of the week in terms of the dividend cuts and the one-off items that were a hit to profits. And as a result, we saw a bit of a bounce back yesterday in its stock, but down 5% today. And it has to be said, again, that was that sort of broader financials theme that weighed on the markets today.
I thought more banks would be on the laggards list, but we still have Fortescue there, Champion Iron. I think it's also just the commodities situation that we saw today, that pressure coming from that space, the resources. I don't know any announcements that Fortescue made today.
Nothing of the sort necessarily.
So I think it's just a general sentiment in the commodities price pressure that it's putting on those big companies. So there we have it, the leaders and laggards for today.
Yeah, absolutely. And I was just trying to look for Imaging, no news there necessarily, but also down there on the laggers list. And well, let's quickly jump across the small caps and see what we've got there. Well, Legacy Iron Ore, up to 28%, but it's going to happen if you move a fraction of a cent and you're a 2-cent stock.
No, indeed.
Yes. We'll move on there because I think everyone can see for themselves just some of the big swings. Anyone else that jumps out in terms of the laggards in the small cap space? My favourite, Jervois Global, down 11.1%. Obviously, that trade that I said I'd put on yesterday hasn't been filled to pump up the price. So, sorry guys, haven't done that yet. But off just a small margin. Again, all very energy centric. The nature of small caps, the nature of today's trade, where it has
big
been
swings for those at the top there.
Yeah, no, without a doubt. But well, I guess that kind of takes us to the end of a week. We got there, eh?
Yeah, we did. We got there indeed. I mean, it really was a very flat week. To be honest with you, I think everyone was just looking for some sort of direction. All right, there's a last a check on the markets there, so down by 0.57%.
Yeah, so the CBO 200 down 0.57, ASX 200 down 0.43 for the day, which will mean 0.42% drop for the week, and that's the first week of declines we've actually seen for 3 weeks. So ends a little bit of a positive run, but again,
and maybe people are on holiday.
That's the long weekend. The volumes
maybe
have been
people are already on holiday.
Yeah, volumes have been really light. So it's hard to take any of this price action as being particularly significant. But again, we wait, we watch, and we've got plenty of economic data, plenty of news coming up next week.
Plenty of guests trying to break it down for us.
Absolutely, including a public holiday on Tuesday as well. So I think that'll be very much welcome by everyone too. We always like to get our Anzac Day off. But for the time being, we may as well call it an end to another week. Tessa, it's been great to have your company the last couple of days.
Yeah, it's been great to be here. Thank you, Kyle. And thank you guys for watching.
Absolutely. Well, remember, you can catch up on all the views and interviews on your website and app. Until Monday, have a great weekend.
Have a great weekend. Bye.
The COB is brought to you by eToro. Invest in ASX shares with $0 commission.